Want to know what Europe does for you? Welcome to the European Parliamentary Research Service podcast on the EU's economic policy.
Since the 2008 economic and financial crisis, EU member states have accelerated works to strengthen economic governance, banking supervision, and to reduce economic divergences between EU countries.
But differences in national approaches on how to complete the economic and monetary union are stalling progress towards further economic integration. Want to know more? Stay with us.
While economic policy remains in the realm of individual member states, EU countries coordinate their national economic policies so they can act together in times of trouble. And this coordination has been pushed even further by the 19 countries that share the euro as their common currency.
But the 2008 global financial and economic crises exposed serious weaknesses in the EU's economic governance framework. The deterioration in member states' fiscal positions and increasing debt levels led investors to lose trust in member states' capacity to maintain sustainable public finances, causing spreads, the difference in the yields of different governments' bonds, to rocket up to unbearable levels.
Given the high degree of economic and financial integration and the risk of spillover effects, this quickly became a euro area problem requiring euro area solutions.
So 2 solutions were found at EU level. The first consisted of financial assistance mechanisms to help member states in trouble, such as the European Financial Stabilisation Mechanism, the Financial Stability Facility, and the European Stability Mechanism, which has become the world's largest multilateral financial institution, with an effective lending capacity of up to 500 billion euros.
The second solution, which was initiated in 2011 and is still ongoing, involves strengthening the economic governance framework of the euro area by setting up a robust and effective framework for the coordination and surveillance of member states' fiscal policies.
It also involves a procedure to spot and correct macroeconomic imbalances at an early stage, and the establishment of a banking union which aligns responsibility for supervision, resolution and funding at EU level, and requires all euro area banks to abide by the same rules.
In 2012, discussions began on how to further integrate the frameworks for the financial sector, budgetary matters and economic policy. After several reports, the EU institutions came up with a plan to complete the Economic and Monetary Union, or EMU.
So on the basis of the 5 Presidents' report, as it became known, action began to unfold, with a first wave of initiatives in 2015 and a second that followed in 2017. Stay with us and we'll walk you through them.
In 2015, the Commission proposed to apply the Stability and Growth Pact structural reform and investment clauses more flexibly, so as to encourage member states to carry out more investments and structural reforms to dynamise their economies.
That same year, the Commission decided to revamp the European semester. That is the EU's annual cycle providing guidance and surveillance to prevent, detect and correct problematic economic trends, such as excessive government deficits or public debt levels. The idea for the reform was to better align the overall EU and euro area recommendations with those of individual member states.
At the same time, the Independent European Fiscal Board was established to advise the Commission on the overall direction of fiscal policy of the euro area and to evaluate how the EU fiscal governance framework was being implemented.
The second wave of initiatives aimed at completing economic and monetary union began in 2017 and is still ongoing. The measures consisted, for example, of a proposal to establish a European Monetary Fund modelled on the IMF, a strategy to better mobilise EU funds in support of much-needed national reforms, and the creation of a European Minister of Economy and Finance and a budgetary capacity for the Eurozone, both supported by the European Parliament.
In May 2018, the Commission also proposed the establishment of a reform support programme and a European Investment Stabilisation Function to absorb large asymmetric macroeconomic shocks in the euro area and the countries participating in the European exchange rate mechanism.
So what's likely to happen in the coming years? Stay with us.
Well, according to a series of Eurobarometer surveys conducted for the European Parliament, the share of European citizens who would like the EU to intervene more in the field of economic policy has grown from 52% in 2016 to 58% in 2018, even if opinions vary significantly across member states.
And in the field of economic policy, the European Parliament cannot be accused of inaction. In recent years, it has outlined its vision and pushed for more action in several areas. On the economic policies of the euro area, for example, it has highlighted the need for better coordination through improved implementation of the Commission's country-specific recommendations.
Concerning the review of the economic governance framework, the Parliament has underlined the importance of simple and transparent procedures, as well as more democratic accountability. It has also advocated the strengthening of the EU's social cohesion funds in order to create more jobs and for a fiscal capacity for the euro area based on own resources and a proper European treasury that could borrow money when needed.
And MEPs are also convinced that both the European Parliament and national parliaments should play a greater role in the renewed economic governance framework.
So how are we likely to see the economic and monetary union deepen in the coming years?
Well, while many of the first stage actions of the roadmap to completing the economic and monetary union have either been completed or are in the process of being finalised, the second stage is still under discussion.
The reflection paper on deepening the EMU proposed action on 3 key areas: completing the financial union, achieving a more integrated economic and fiscal union, and strengthening euro area institutions. And in 2017, the Commission came up with a list of concrete initiatives to achieve this.
Several member states have also come up with their own proposals and ideas, and divisions have become evident. To sum up, there are, among EU member states, some that believe EMU should be reformed as soon as possible, that is, before the next crisis hits Europe, and others who believe other reforms should be prioritised.
And divisions don't stop here. Inside the EMU reformers group, there are those member states that prioritise risk-sharing measures such as France, and those that defend further risk reduction initiatives such as Germany.
However, and despite the tensions and divisions, EU leaders meeting in Brussels in December 2018 managed to approve a package of measures to bolster the Eurozone, even if no consensus could be found on the risk-sharing instruments, which are key to completing the monetary union.
But leaders endorsed the creation of a European Stability Fund to help Europe's ailing banks with around €60 billion as from 2024, and agreed to give more powers to the EU's Rescue Fund so it is better able to support countries in trouble.
However, the most ambitious reforms are still to come, namely a European guarantee for bank deposits under €100,000 and a Eurozone budget to stabilise countries suffering from sudden shocks.
So we'll have to wait and see if 2019 brings us some real breakthroughs.
You're listening to the European Parliamentary Research Service podcasts.